Hello, my name is Evan Serton. I'm a portfolio specialist at Cohen & Steers. For the U.S. REIT market, the first 5 months of 2021 have been a welcome change from the pandemic challenges of 2020. We've seen the distribution of COVID vaccines trigger a reopening of the economy that has had a positive effect on demand for all kinds of real estate and on REIT share prices. We've also seen the prospect of continued government support drive expectations for meaningful economic activity. As we continue to anticipate an accelerating economy and a healthier environment for commercial real estate in the months ahead, we're also hearing a lot more about the potential for inflation to reach levels not seen for years. And so part of our work is to understand how inflation might affect our asset class. Today, I'd like to share some key observations when we look at the behavior of the commercial real estate market amid periods of rising prices. Namely, 1, real estate properties' historical relationship to inflation. 2, the fundamental drivers behind real estate's inflation sensitivity. And 3, how REIT share prices have responded to rising rates. The first observation is that real estate values tend to rise with inflation. Increases in the cost of raw materials and labor make it more expensive to develop new properties. And so existing landlords have less competition and enjoy higher barriers to entry. As we saw during the last commodities boom, prior to the global financial crisis, this can lead to a supply and demand environment very favorable to rental growth. The second observation is that the leases that certain REITs have with their tenants include terms that explicitly raise rents over the life of an agreement. For example, REITs that own cell towers typically lease them to wireless carriers in agreements that can span from 5 to 15 years. These leases often include a 3% rent escalator annually. Agreement terms in the triple net lease sector may span as much as 15 years, with annual rent escalators typically averaging 2 to 3%. The third observation is that despite what some market participants may believe, higher interest rates are not necessarily poor conditions for REIT performance. Accelerating economic growth, even with higher rates and prices, is really the most important backdrop for REITs to thrive. It's this higher economic activity that can lead to higher demand for commercial real estate. In this sort of scenario, as leases expire, landlords can adjust their new rents higher to match a new economic reality. While there are risks and no guarantees, this has typically led to improving fundamentals that has often rewarded REIT investors with higher share prices. The long-term ability of REITs to deliver dividend growth that typically exceeds inflation is evidence of this effect. And so the prospect of inflation can bode well for real estate, given that it introduces higher barriers for competition, allows landlords to incorporate rent escalators into longer leases, and also lets them reprice rents completely as shorter leases expire. Given the accelerating economic conditions that exist, we believe that now is a particularly favorable environment for REITs. Thanks very much for listening, and we look forward to speaking with you again soon.